Hey there, my name is John Stevenson, and welcome to the Guaranteed Retirement Guy Show. I appreciate you tuning in today because today we're going to be talking about the correct amounts that you should be putting into annuities. So you might be wondering, well, what should I put into an annuity contract for myself? I want to put this much in, but I've got advisors over here telling me to put in just this much, but I want to put in more. Can I put in more? Should I put in more? Let's talk about that, because I have a lot of people that want to put as much as they possibly can into these. And if you put too much, your application will be rejected by the carrier just because they want to make sure that you have just a certain percentage of your assets going into these annuities. And I'm going to share my screen here in just a second. I want to show you kind of what this would look like depending on what you put in. But I just wanted to caution you, whenever you think about putting money into annuities, make sure you're putting in the amount that you need as far as, hey, the amount that you want to protect from market risk, the amount that you want for guaranteed income. Okay, maybe you just have some money that you want to park somewhere, like a MIGA, known as a fixed annuity contract. You can park your money in there, but it still has to be a certain percentage, okay? Normally, rule of thumb, as far as the max, is you really can't put in more than 75 and maybe 80% of your total assets. And that's on the high side, okay? Most people would recommend, I would say, between 30 and 50%. But everyone's in a different situation. A lot of people that reach out, they're like, I'm not in a position where I can get all of the income I need from just 30% of my assets or even 50%. And so not everyone has $3 million. Some people only have $500,000 and they need to be able to maximize what they can get out of it. But still, you still have to keep some money outside of it. If you got $500,000 and it's total liquid cash, then you should probably plan on keeping at least $80,000 to $100,000 in cash or similar outside of your annuity contracts. So let me share my screen. I want to show you what this would look like. And I'm going to throw in different amounts here, different variables. And it's really not as bad as you might think. I mean, if you're thinking, hey, I don't have enough money for this, and I want to make sure we have enough income. How do we make this happen? A lot of times you have to just buy it early enough, and you got to make sure you defer it long enough. And it's not as long as you might think. I mean, it's different for everyone. But I think when I share this, I think this will probably help as you look for annuities. And of course, if you want to look for annuities yourself, go to my website, johnstevenson.com. You'll see my annuity calculators there. And I've got data feeds directly from all the carriers there that will give you all of the information, all of the payouts from all of the annuities available. So, and then when you're comfortable and you're thinking, hey, I'd like to buy an annuity with John, then I'd love to help you. Okay, book a call and we can chat some more and I'll answer your questions. Not going to try to hard sell you anything, but I will show you what's available. And of course, I'd love to help you if it turns into that. So, all right, so looking at my screen, let's take a look at this fictional client that I am basically placing in Colorado, and I'm giving them $1 million. Okay, this is on the high side for a lot of my clients. Most people will put in maybe 500 to 700,000. There are some that put in only 100,000 to 300,000. Just depends on what your circumstances. But if you are looking to put money in, and this is just assuming, and again, this is looking at a joint payout, and I'm just making it very simple. I'm saying both spouses are 66 years old and they want to take income at 71 because he's going to keep working or she's going to keep working. And they want to take income after 5 years. So I'm not saying you'd wait this long. Obviously, this is going to generate a decent payout, but I just want to kind of start this with this so you can kind of see what's available. All right, so based off of that, and you can see everything here, there's a lot of options here. There's a lot, and that's just the first page. You'll notice there are some accelerated payouts here. And you'll notice that on my website when you go to the income rider, because that's what we're looking at right here. And the reason why I show the income rider most of the time is because it generates usually the highest annual payout, which is usually what most people want. So looking at this, you'll notice there's some huge payouts, $154,879. You're like, wow, I definitely sign me up for that, right? The problem is it does reduce. Okay, you have to realize that they only give that to you for a couple of years. Okay, the 154 grand, then it reduces to 103. So this is known as a accelerated payout, kind of like for the go-go years, except for this one really isn't that long. It's like only for 2 years. Here's another example. So $137,750 from Corebridge, and it reduces to $79,750 at age 78. So they give it to you longer, it's just not as much. So let me illustrate that so you can see what it looks like. But these are good options for bridging an income gap. And I'll show you the other options that never decrease. So I just want you to see these because my calculator, my income rider calculator, will show these on the top. And it's usually Nassau, Meritas, American General Life. A lot of times those are the ones that show these accelerated ones right there on the top. But you can see here it's 137 grand, keeps going. And then of course at 78, it reduces to 79,750 for the rest of your life. So this can be good, especially if you're looking to take a later pension or, defer taking Social Security. This would be good for someone who is 60, who wants to retire early, but they don't have the income to do it. But using one of these products, they can look at it and say, all right, well, this will actually work for me. I can retire early. I'm going to take my Social Security. I'll take a later pension. And then with this reduced payout, it'll be perfect. So it allows you to retire early when you want to and be able to take less income later on. This is not the most popular option. Most people do not pick this because they don't want their income to go down. But I still wanted you to be aware. All right, so going back up here, I'm going to go and I'm going to say I want no income reduction. Okay. And I'm just going to clean this up a little bit. I want to see the top annuity per carrier. Okay. So we'll just make this a little bit cleaner here. All right, so basically, if we're looking at highest income from an income rider, income that will never decrease, then you can see these top ones are right here. You got Nationwide, Corebridge, ClearSpring, and all the rest of the other companies. And they're all pretty good. But if you look at the top one here, it's with Nationwide. And Nationwide Peak right now, at least as of the recording of this video, is very competitive. And a lot of times these top companies will they'll fight for the top spot. And so it might be Corebridge when you see it. Okay. It might be Athene. Athene was the top one last year. They were really fighting to be competitive on the income side. So it just depends. But a lot of these top companies will they'll jockey position. And sometimes you'll see one on the top one time and the other on the top of the other. It just means that they choose to be more competitive at different times. So, but when you're looking at this with Nationwide, it's pretty good. I mean, we're looking at a $1.75 million benefit base, okay, at the end of 5 years. And then that is multiplied by 6.55, giving you $114,625 for the rest of your life. This is joint income, never decreases. Pretty nice, huh? And you can see if you took this out, it's like $2.8 million by the time you're 95, okay? So you're just buying a pension. Okay, it's not a growth product. You're not trying to beat the market. That's not what it is. You're buying a pension, and if you want to leave the rest of your money in the market and grow, then that's a very popular way to do it. People will buy these for their pension only, and then they'll leave the rest of their assets to their kids or for growth or whatever. So it's a very good strategy, and it's very popular, especially with very wealthy people. Even people that are not so wealthy, it's still a popular strategy because you might have 800 grand in, and you're like, oh, I don't want to put all this in. I want to put like 400 grand or 500 grand. You could do that and let the rest of your assets ride in the market and compound and grow. That's a good strategy if that's what you're looking for. Okay, so I just wanted to show you how this worked. If you go down here, you can see this surrender charge schedule. This is if you surrender it, you cancel it, which that's why they want you to have enough cash. Okay, that's why we're talking about how much is enough, right? Well, you can't put too much in, right? Because if you put too much in, you're not going to have enough for savings, enough for emergencies. And then if you have those things happen, then you're going to try to get out, or you try to take out more funds and get subject to a surrender charge. This is why they limit as far as how much you can put into these. Okay. So just put in the amount that you need. And I'll just go right back to the premise of this video. It's all about what you need. You don't need to put any more than that. I mean, you can if you want to generate more income. I got people that buy a bunch of these contracts and they'll just generate more and more streams of income because they want to. There's nothing wrong with that. But if you don't want to, if you want to keep as much money in the market or in other investments, then only use the amount that you need to generate. Okay. So, and I just wanted to show you the surrender charge schedule is here. It's usually 10 years. And then you got the roll-up rate of 8% yearly. And that's a simple roll-up rate, simple interest after the 25% base bonus. That is what makes all of this work up here. Okay. This is what equals the benefit base of 1.35 at the end of the 12 months because of that 25% bonus and the 8% simple roll-up. And then each year, that simple roll-up, again, that's giving you a pretty decent amount. We're talking 100 grand dropped onto this benefit base every single year until you take income. And then, of course, that's multiplied by that lifetime withdrawal rate right here. So that's how it works. And if you want to take income earlier, then these are the amounts here earlier. So these are very flexible. If you want to wait longer, you take out more income. So let me go back. And let's say you're thinking, you know what? I'm 66 and I want to take income right now. Okay. Let's see what it looks like. All right, so there's no time for deferral. So obviously, the longer you defer it, the more income you get. But it's still decent. You're getting $74,000 right from the beginning. So that's dropping in your account every single month. So we look at that and we'll say, all right, well, What is that monthly? Almost $6,200. Okay. But now you might be thinking, well, that's too much. I don't need that much, or I don't have that much money, right? And so maybe you got $1 million and you're thinking, I only need to generate $3,300 a month, John. I've got my Social Security, got my pension over here. I just need another $3,300 and I'm good. What is the minimum, right, for that? Let me just go in here. We'll say, I'm going to reverse engineer this. And you can do this on my website, on my calculators, same thing. It'll ask you either what amount you want to put in, or it'll ask you what kind of income you want to generate, okay? All right, so let's say I want $3,300 per month, okay? Now it's saying $532,000. So maybe you got 850 grand. You're like, all right, I don't want to put all my money in. I just need just enough for $3,300 a month. And you can see, of course, Nationwide is the top one. They're giving you that $3,300 a month, and this is a premium they require. Prudential requires more premium. Corebridge and Gillico and F&G, they all require more. And so they're just not as competitive for income, and so they require more premium. Let's go here, and I'll just show you the actual annual amount so you can see that. There you go. It's $39,600 per year, and that would start next month. Okay. And I do these all the time for people, and it's a great way to just create lots of peace of mind and be able to provide yourself the income that you need. You only needed to use the amount that you needed, which in this case was $532,437. That was the exact amount you needed to bridge that income gap. And then, this person had $850,000, they've got another $320,000 that's left in their account to grow. So if they leave it in the stock market, rule of thumb, at least we're told that every 7 years, it will double, right? So if I keep my money in the S&P 500, it will typically double every 7 years. So that's not bad. They're back up. They're back up to like $640,000 in 7 years, and they've got this lifetime income. So it's a great way to let your other assets grow and still be able to have the income that you need from an annuity contract. So hope that helps. I hope you have found value from this video. I try to keep these short. If you do want to buy an annuity and you're thinking, hey, I'd like to work with John, then I invite you to book a call with me. I'd love to help you. I'll answer your questions and won't try to hard sell you anything. Of course, I'd love to sell you an annuity. That's how I make my money. But if you are looking seriously to purchase, I'd love to earn your business. So I appreciate you watching the video. If this video helps, make sure you like, subscribe, share, and watch the other videos on my channel. There's a lot in here as far as the library. We got hundreds and hundreds of videos that answer so many different questions. I would invite you to go through that library and look up. As you go through YouTube libraries, you can actually look up by topic and be able to see answers to many, many questions. So anyways, hope that helps. I appreciate you watching, and we'll see you next time.